Hello, grade 12s. Welcome back from the short break that we've just had. Remember, it's economics with Ms. Piwe. And just before the ad break, we were looking at the terms of trade. We defined what terms of trade is, and we also looked at the table that was provided or supplied by the South African Reserve Bank. So we are now going to continue and explore a bit more further in terms of what the terms of trade is. So we know that the South African terms of trade index increased in high rates in 2009 and also in 2010. If the numerical value indexes increase, it is said that the terms of trade have improved. If the numerical value decreases, it is said that the terms of trade have deteriorated. So how can we go about improving the terms of trade, or what could cause an improvement in the terms of trade? So a few things, when there's an increase in the export prices. So we know that when we export goods to other countries, that is considered to be a good thing. So it's a good thing to export. So thumbs up, okay? And then we try and minimize the import, because then we've got money leaving the circular flow when we import goods into a country. And then a decrease in the import prices, that would also create an improvement on the terms of trade. So we need to export more and import less goods and services, because we can't get to a point where we are not importing any of the goods and services into the country, because we know that we are not self-sufficient. We do depend on other countries for certain goods and services. So if this happens, this will cause an improvement in the terms of trade. And that would be a positive thing in terms of economic growth as well. What could possibly go wrong? So what could hamper the improvement? So a few things could. So when there's a decrease in export prices, so if we are now exporting less goods and services to other countries, that will make the situation worse, because now we are not receiving that cash injection that we were receiving when we had more export activities happening in our country. And also when there's an increase in import prices, so this will then cause a difficult terms of trade situation, because we are not exporting more items, but instead we are importing more items. So the prices of import, if they increase and the prices of export decrease, that will not be an ideal situation. So this over here is the ideal situation, where we have an increase in the export prices and also a decrease in the import prices. So it's always good for a country to export more goods and services because they are getting their foreign currency as well. We know that if we export to countries like the US, when we get their foreign currency into the circular flow, it is good for economic activity because their currency is strong as well. So it does give that nice boost into our economy. And then our next concept is the concept of free trade and protection. So free trade happens when producers and consumers are free to buy goods and services anywhere in the world without interference from a government. Okay, so that's an ideal situation. So we go overseas, we do our shopping, we can bring in items, government is not going to interfere. When we get to the airport, you know, we will not be asked to produce documents in terms of bringing goods into the country. So this is like a happy situation when we've got free trade, because there is no government interference. So you're allowed as a producer and also as a consumer to freely buy goods and services from anywhere in the world without the interference from the government. So this is good stuff, you know, but that's not reality. And then protection occurs when there are limits. So limits the extent of trade between countries, for example, limiting imports. Okay, so we know that government tries to support the local suppliers by encouraging citizens to buy from local suppliers. It is a good thing. We had that huge campaign that was going on with Proudly South African goods and services, trying to encourage more and more South Africans to support local suppliers because, they depend on us. Because we are so well traveled as a nation, we go overseas for business and all other things, we get exposed to other brands that we end up liking. And then when we come back, then we seek to import those brands into our country. And then that actually affects the local suppliers because they do depend on us in order to supply them so that they can generate an income and be able to participate in economic activity. So what is the South African's foreign trade? So South Africa has a relatively open economy. Foreign trade is approximately 30% of the GDP, which means that the economy at large is sensitive to changes in terms of trade. Okay, so we are a very open economy. We do encourage the trade with other countries because we know that we are not self-sufficient and that we are dependent on other countries for certain goods and services. So international trade is encouraged, but also we do support our local suppliers and we encourage our citizens to actually buy from local suppliers as well, because then they use the income to support their families and to create employment opportunities, but also the money stays in the circular flow, so which is then good for the economy. But approximately about 30% of our GDP is from the foreign trade. So foreign trade is something that is obviously encouraged in our country. And then moving on, so the composition of our exports and imports in table 4.4 show that mining and manufacturing will be more sensitive in terms of trade than, for instance, agriculture. Okay, so we know that mining and manufacturing are key industries. We know that we're a country that is very rich in minerals or mineral resources, and we manufacture a lot of goods and services that we export to other countries. And then we said for when there's a surplus in a country, then the country is encouraged to sell that to other countries in order to generate an income. And earlier on I said, the mining resources that we have in abundance, and therefore we do export some of those mining resources to other countries. And there are certain products that we manufacture in our country that we export to other countries. So that's good. So these two will be more sensitive in terms of trade than agriculture, which is more for local use, because the crops that are grown, we tend to consume them, because I don't think we're in a position where we are making that in abundance that we end up with a surplus and now we are having to export to many countries in the world. So the two areas that will be hugely affected and that are more sensitive in terms of trade, that is mining and manufacturing. So just remember those two. And then how do we go about making corrections of the balance of payments? So there are a few steps that we can follow and apply in order to make the corrections in the balance of payments. So the balance of payments will be at disequilibria when the outflow of foreign currency continuously exceeds or is less than the inflow of foreign currency. Okay, so here's that relationship between outflow and inflow. Okay, so then if this is the case, then we are sitting with a disequilibrium. So we need to correct this. So you will remember that a deficit on the balance of payment implies that the outflow of foreign currency exceeds the inflow of foreign currency, while a surplus exists when the outflow is less than the inflow. Okay, so it's important to have a look at the export and the imports in a country. Ideally we should be exporting more and importing less. And then, we don't want to find ourselves in a situation where we are importing more and exporting less. So we end up with a disequilibrium. So we try and put measures in place in order to correct that, to manage the inflows and the outflows. So a way to correct the balance of payments disequilibrium lies in earning more foreign exchange through more exports and reducing the imports. Okay, so I'm going to move up. There we are. My screen is now behaving. Okay, so we're reducing the imports, but we want more exports to happen. And that is a measure that can be used to correct the payments or the balance of payments disequilibrium. So the fact that we can have more exports and then try and reduce the imports that we have in the country. The following are methods that can be used to correct the deficit or surplus on the balance of payments. So let's have a look at these methods. Okay, the first one is the lending and the borrowing. So countries with surpluses often lend money to countries with deficits. Countries with deficits often borrow. Okay, so then this is also considered as a corrective measure that could be applied. So obviously, if you've got more, you can lend to another country. If you've got less, then you have to borrow from another country. This is why some developing countries have so much foreign debt that they have to pay. In the event of a fundamental disequilibrium, member countries may borrow from the International Monetary Fund, which is also known as the IMF. Okay, so if you feel that you need to borrow as a country, that is the institution that you can approach. Borrowing is nevertheless not a long-term solution for fundamental balance of payment disequilibrium. So this is a short-term solution and is not a long-term solution. So there are other options that a country needs to explore in order to balance its balance of payment disequilibrium. So borrowing will just be a short-term solution that a country can use to correct the balance of payments. Then we've got the change in exchange rates. So we're looking at currency depreciation or devaluation. So it makes the imports more expensive for domestic customers and exports cheaper for foreign buyers. For example, when the rand depreciates, South African goods, which are exports, become cheaper for foreign buyers. Imports become more expensive. Okay, so when the rand depreciates, it means that we can export more because it is cheaper for the foreign buyers. But also it makes it more expensive to import goods into South Africa because the rand has depreciated or is not in a strong financial position or financial place in order to compete with international currencies or markets. You can also have a change in demand. The following four instruments are used in various countries to restore the equilibrium. So you've got the long-term policies, export promotion, so you promote the goods and services in your country to other countries. So export promotion, such as government incentives, is applied to encourage the production of goods that can be exported. For example, the European countries pay subsidies to farmers. Okay, so government could actually play a role in promoting the goods and services by giving certain incentives to producers so that they can produce goods and services that could be exported. Import substitutions, for example, government incentives to produce goods domestically rather than to import them. Then the South African government favors export production because when we export, then we get cash injection into our economy, and that's always a good thing. Interest rates also play an important role. So domestic demand can be changed by changing interest rates. If interest rates are increased, spending, including on imports, decreases. So foreign traders will try to find advantage by increasing their investment. Okay, just going to move down. So by increasing their investment in the country with the higher interest rate. The opposite happens when the interest rates are decreased. So interest rates could be used as well to correct the disequilibrium that occurs in the balance of payments. And then the import control, they include import tariffs, other duties and quotas. The WTO is trying to phase them out for the sake of trade liberalization, to make sure that it's liberal to trade and that you are not limited to certain rules when it comes to international trade. All right, so now let's sum up our lesson. So in this lesson, we covered the following concepts. We looked at what the foreign exchange market is a market engaged in the buying and selling of foreign exchange. The leading markets are London, New York, and Tokyo. And then also we learned about the appreciation of a country's currency is an increase in the price of the currency in terms of another currency due to market forces. For example, when the dollar goes from $1 to 9 Rand to $1 to 10 Rand, then the dollar has appreciated. Then the depreciation of a currency happens when, okay, sorry, just want to move up, there we are. So the depreciation will happen when there is a decrease in the price of the currency in terms of another country's currency due to market forces. For example, if the dollar goes from $1 to 9 Rand to $1 to 8 Rand, then the dollar has depreciated against the Rand. So those are the important concepts that we have covered in this lesson, and I trust that you've enjoyed today's lesson and you've learned so much from this lesson. So remember to stay tuned to these programs, and I'll catch you on our next lesson. From me, Uspiwe, it's a wrap and goodbye.